In that case, good morning, good afternoon, good evening. It is a pleasure to have you all here from across global time zones. And welcome to our conversation on investing in women, applying a gender lens for impact. I'm Isla Panic Marquetta, alumni from London Business School and also startup founder and CEO of u for u On behalf of the Harvard Kennedy School Women's Alumni Network, the Harvard Business School Women's Association, and the London Business School Women in Business Club, thank you for joining us. And over the next hour, we're going to explore something that represents both an enormous opportunity and an urgent imperative: how investing with a gender lens can drive meaningful impact while generating attractive returns. So here's a question for investors in our audience. When was the last time you looked at your investment thesis and asked yourself, what assumptions am I making about what success looks like and who gets to define this? And a question for those of you that are here seeking funding. I wonder if you've ever felt like you're trying to fit into a mold that wasn't made for you. For those of you here that are looking to invest, have you ever wondered what opportunities you might be missing simply because they don't look like what we've been trained to recognize as opportunities? Traditional investment models, they were built on pretty narrow set of experiences and networks, and they're leaving extraordinary value on the table. We're not just talking about funding gaps, we're talking about a fundamental reimagining of how capital flows and how we measure impact, returns, who gets to participate in wealth creation. So gender lens investing challenges us to think about better questions like, what if we designed investment structures that account for how entrepreneurs build businesses today, not just how we've always funded them? What if we measured success beyond short-term financial returns to include the ripple effects on communities, supply chains, ecosystems? So the exciting part is we're seeing pioneers prove that when we expand our lens, we don't just create more equitable outcomes, we unlock innovation, resilience, and returns that conventional approaches often miss. So whether you're here as an investor looking to incorporate gender lens strategies, or an entrepreneur seeking to understand how to access capital, an inspiring investor curious about the opportunity, or a business leader committed to driving positive change, we're very pleased you're here to engage in this space that we created for you. And to guide us through this conversation, we've assembled a panel of practitioners and thought leaders who are actively shaping the future of investing in women. So welcome, Julie Castro-Abrams. Julie is the founder and general partner of How Women Invest, a venture fund laser-focused on top women-led companies. And with over 25 years in financial services and having supported more than 6,000 women entrepreneurs, Julie doesn't just talk about change, she creates it. And as CEO of How Women Lead, she helped pass California's groundbreaking SB 826, which mandated women on corporate boards. Julie is on a mission to demystify venture capital and empower more women to both fund and scale women-founded companies. And welcome, Aunnie Patton Power. Aunnie works at the cutting edge of innovation finance, catalyzing models that unlock systemic change. She's a former M&A banker with a strong background in impact investment. She's the founding director of the Innovative Finance Initiative and an associate fellow at Oxford Saïd Business School. She directly advises family offices, foundations, and fund managers globally. Aunnie is also the author of Adventure Finance, which explains diverse practical funding options beyond venture capital. And John Mullins, welcome. John is an award-winning associate professor at London Business School and best-selling author whose TED Talk has attracted over 3 million views. His newest book, Break the Rules, identifies the counter-conventional mindsets that drive entrepreneurial success. John has contributed powerfully to this conversation through his research on women entrepreneurs, exploring both the systemic barriers they face and the tremendous opportunities that gender lens investing can unlock. And our panel moderator, Jimena Barrera, welcome. And thank you very much for being integral for this event happening today. Jimena is a board member of the Harvard Kennedy School Women's Alumni Network. She serves as a mentor at the Miller Center for Global Impact, working on mission-driven tech founders, primarily women, on their path to investment readiness. As a member of both the Innovative Finance Initiative and the Regenerative Capital Institute, she is passionate about evolving investment practices to unlock capital flows that serve people, planet, and flourishing communities. And I will turn it over now. Jimena, thank you so much.
Thank you, Ayla, for the introduction. Thanks to our organizing team, to our speakers, and to all of you in the audience for your time with us today. Julie, Aunnie, John, welcome. Let's start with foundations. What is gender lens investing? And what's the most impactful work you are doing in this space right now? Let's begin with Aunnie.
Absolutely. Thanks so much for having me. This is lovely, wonderful company to be in. I would just like to say, Jimena, that's the first time I've been on a speaking thing and someone has introduced themselves as being a member of the Innovative Finance Initiative because we're only a few months old, so that was very cool. So let's just first of all take it separately. So everyone knows obviously what gender is, but the idea of lens versus thematic investing is quite important. So when you are a healthcare investor, you look at the theme of healthcare, so you invest in healthcare deals. Whereas there's within impact investing, this emerging idea of lenses, which are cross-cutting. So you can have gender lens investing, you can have racial equity investing, you can have disability investing, you can have refugee investing, and these cross-cut things like healthcare, education, climate, and really look at the intersectionality of both the kind of the issues that individuals face, but also what impact an investment thesis has on them. And so I think it's really important to think about how our investments empower women as consumers, as founders, as business people, within supply chains, and that's where gender lens comes in. So for me, I love seeing more female founders, and I think the biggest thing that what my work focuses on is really redesigning the way we allocate capital, because I think that lots of female founders opt out of equity funding on purpose and then are told they're uninvestable. And so changing that narrative around what does it look like to create fit for purpose capital for women.
Great. Thanks, Aunnie. John, what's your perspective on this?
So I think Aunnie has defined gender lens investing very nicely. My interest is on the women entrepreneur themselves. What can they do to make themselves backable in whatever form, whether that's impact investing, whether that's more traditional investing. I think there are a number of things founders can do with their business before they even start it, as they conceive it, in order to make it investable. And so that's my real passion.
It's very interesting, John. Julie, please go ahead.
Yeah. So I'll do a 60,000 foot zoom out for everybody to think about. There's some interesting things that happen developmentally in your life. So if you're over 40, this is a bit of a message for you. But in your 20s and 30s and early 40s, you're building your life. You're building your career, your family, your homestead. And in your mid 40s, you actually wake up, and a lot of us find this call to have an impact. And in fact, women, it is a developmental life stage. So just so you know, if you're feeling this like, I got to do things differently. I want to align my investments with my values. I want to be part of making the world a better place. I made my money and did my thing. Now I gotta be part of the next thing. It is a developmental thing. And we're happier if we do things with other women, if we have an impact. In Middlescence is the name of this life stage, by the way. And so what I find is a lot of women come to me and they're like, I have so much shame because I've been making money, putting it aside, and I haven't been able to look under the hood. And the reality is that's just normal. Forgive yourself, but it's time. So if I say to you, like, do you care about climate? Do you want us to have the explosion of prisons in the United States? Like, what are your core values? And gender as one of those. And then you kind of come up with your lines in the sands, and then you look at your Schwab portfolio or whatever it is. A lot of us kind of take a gasp and we're like, oh my God, I can't believe I've been doing this thing wrong. And so I just think a lot of us actually developmentally need to take a gender lens view emotionally, physically, for our personal need in our mid 40s, 50s. And so I just want to encourage everyone to think about like this is actually part of what is critical to you and your legacy and how you live in the world, to define your values and actually align with them. There's interesting things that I've experienced. There's something called the Hypatia Capital. There's something called the WCEO ETF. Okay, this is what this is. An electronically traded fund is an investment vehicle that's liquid. You can invest today for $33, I think, in one little share of it. They have all of the public companies that have a woman CEO in that, and that is $500 million or larger. So big institutions, right? So there's a vehicle you could look at, right? Well, what's interesting about this, not only could you invest in that vehicle, but what's happening is it's creating a clear data set for all of us. When you do have women CEOs of public companies, not only is their performance different, but do they behave differently? And can we look at the different way that people are actually running those institutions? And we find that women CEOs of public companies have 80% more women in their C-suites, not just the head of HR. So I actually think about gender lens, not just like, am I investing in, I mean, I have a venture firm, I invest in companies founded by women, very clearly. I'm also driving capital to women-run venture firms. That's one kind of thing, but I actually think going beyond just like the obvious, that's one check mark, okay, you can do the obvious, but actually, what does this actually now mean for you getting equal pay, getting opportunities in the corporations, and getting family and medical leave, all these things you care about? What happens if you actually invest in the companies with women CEOs of public companies? And does that actually change the life for you, people you care about, and your people around you? Anyway, I just wanted to kind of give you guys a little bit of a different frame that might not be so traditional.
Those are powerful definitions, and I love the reframing and the questions for us to observe more critically and in different ways what gender lens investing means and the effects of it. And with that, before we dive into solutions, John, help us understand the scale of what we're dealing with here. What are the systemic barriers and opportunities for women entrepreneurs? And what do the numbers and research tell us about the current state of gender lens investing?
Well, thanks, Samina. It's clear that women receive, women-founded ventures receive a pittance of the overall capital that's invested. And there are a bunch of studies that point out that women just aren't getting very much money. But I think the most interesting research is a study done by one of my London Business School colleagues, Alexandra Kasperzik, that was published in Research Policy several years ago. And she and her colleagues were able to get the data on every single startup in Massachusetts and California between 1995 and 2011, so a 16-year period. And their question they set out to answer, they knew there was a gender gap. So things haven't changed, right? There was a gender gap back then, and there's still a gender gap. They wanted to know why. What's driving this gender gap? And their results are really interesting. 65% of the variance that causes this gap, they discovered, was driven by the growth potential of the businesses that were founded. And you might say, well, how did they measure growth potential? Well, they did things like, are there recent patents in the venture? What's the name of the business? So if it's small town floral, that's not a high growth business. But if it's, Jimenez Biotech, that's different. So they had a whole bunch of indicators that they could use as proxies for growth potential. And growth potential explained 65% of this gap that they were able to demonstrate in the study. But that leaves a really interesting question. What about the other 35%, right? So what explains that? And that really comes down to gender bias and stereotypes. Venture capital investing, especially early stage, is highly risky. As Julie knows well, the vast majority of the investments that investors make fail. And in fact, the vast majority of venture capital investors themselves don't make much money. 2/3 of them deliver low single-digit returns or better. So this is a high-risk game they're playing, and most of them are playing in not with their own money, but with other people's money. So they're getting money from pension funds and endowments and so on, and it's their job to deliver a return. Well, if they know that the prior odds of the investments they make, whether they make them in male or female founded ventures, are going to fail or not perform well, then some of them have to be so good that they pay for all the failures. And that's the problem, right? So they can't in the traditional way of investing, and Julie, let's get at this traditional way of investing. In the traditional way of investing, they've got to find ventures that are so good that they're going to pay for all their mistakes. And consequently, if they find a venture, women-led or otherwise, that doesn't look like it has extraordinary growth potential, they pass.
What's so interesting is I just want everybody to really think about this and like where we're at in the state of the world. In 2010, there were only 12 women-run venture firms in the United States. Today, there's 380. It's a new market. It's completely different. We have, so all of our data about actually how women VCs work and largely even how women founders grow at big companies is brand new. It's very recent. But here's the interesting thing, and that we're getting data every day that is like telling this magnificent story. If you look at the very top performing venture firms in the United States, the ones that return the most for their investors, 73% are run by women. I just want you to absorb that. Wait, we only think venture firms are run by men, but 73% of the top performers are run by women. And if you look at the numbers, I haven't seen a data set on this, but I know them, and most of them are women of color, actually. It's very interesting. And women founders return 35% more for their investors consistently. Then there's data that shows even bigger numbers. So the fact that we haven't historically invested in companies founded by women, and we haven't invested in, and women VCs haven't been prescient, they haven't had a big player, role in the country, means that actually all those things you just said, John, that is probably information about men. Because what we're now seeing is, and there's a source of data called PitchBook that you guys can all look at, everybody reads it. PitchBook just did a report that said 60% of all the deals done by these big male-run venture firms are all done with each other. They don't even do due diligence. This is what happens. They do this herd mentality thing. They explode and market in crypto or AI or something like that, and they're not even doing their own diligence. That's not how women VCs work because they're not part of the game. They're not actually invited to that party. I'm not invited to invest in OpenAI. We're investing in a different class and a different type of company. And most women VCs are running firms that are pretty darn small. The largest women VCs, or maybe, I know all of them, I think, and maybe we're, one person is at 500 million. There's only like 20 or 30 that are over 100 million. They're very small funds. But what's interesting is, and when you're the newcomer, when you're small, when you're under resourced, you're more capital efficient, performance driven. That's you are grittier, you're working harder. And we know grit is that's how you get to the win in life. And so what we see is women survive and don't go out of business. I have 3 venture funds. I've only lost 1 company in all 3 funds. We sold in what we're also seeing in the traditional male-run venture space is they're not even returning. There's something called DPI, like returning capital basically to your investors. At 10 years, which is supposed to be the life of the fund, they're still not returning at all. They're extending the life of those funds to 12 and 14 years. Well, I sold 2 companies within 18 months before people even finished doing their capital investments in the fund. And people got almost 40% of the fund back. That's what women founders do differently and women VCs do differently. I'm not trying to promote my results because you can look, they're starting to see aggregated data that shows women don't go out of business. So I'll give you an example. We have 1 person that's in the battery storage and the plus sign of the battery side of think about AI battery storage, great stuff, right? she basically got $2 million in her last round. And her male competitors, colleagues, friends, they got like 20 million. Well, when the market got tight in terms of liquidity, and no one was getting the next round of financing when they wanted it, all the guys went out of business, all of them that she was in this cohort with, and she survived because she only got 2 million in the first place. So she was getting non-dilutive grants. She had skinny, her team was super efficient and skinny. She knew how to be lithe. And I'm not saying that's better, or, there's different things, but there's a story that I think is evolving, and women do it differently because you have no choice. You don't have as many
And
resources.
they can do it better, and they can do it more capital efficiently. And
Because
that's
honestly, I mean,
what it
well, women are
takes.
great, but that's not really the point. The point is not women are better than men. It's that if you don't get a lot of money, and think about your own behavior, you're going to be much more disciplined and careful about how you spend it. You're going to have multiple scenario plans. But if you're like the guy that's getting a billion, getting inbound all the time, and everyone's throwing cash at you, you think that gravy train's never going to stop. So I just think it's interesting to dig into like what is actually really now happening, that we actually have a market to look at. It's brand new info and it's evolving every day, which I
I
think
love
is so
that.
freaking fun,
That's
Jimenez.
very interesting. Like the context setting that John is sharing, which is essential, and also the evolving narrative and the
Yeah.
new market opportunity that Julie is sharing with us. Now, we want to equip everyone here in the webinar with practical perspectives and strategies that you can actually implement. So let's dive in. Um, so let's go first with Ani. So your book, Adventure Finance, advocates for expanding funding options beyond traditional venture capital. Can you walk us through the most promising 2 or 3 alternatives that women entrepreneurs should have on their radar and how they actually access these funding alternatives?
Sure. So Julie mentioned non-dilutive, which essentially means you're taking capital that isn't buying ownership in your business. Venture capital is designed for a very specific set of businesses. Unfortunately, it's been applied as risk capital to all businesses that need money that don't have assets. And that's really, I think, to the detriment of both businesses as well as the investors themselves. The alternatives that I would suggest. The first thing that I would say, and there's a piece in the book on this that's really important, something that most founders do wrong, is understand what type of capital you actually need. Do you need growth capital? Do you need working capital? Do you need asset financing? Because generally what founders do is they need money, so they go out and they raise equity. But when you're financing short-term needs with a long-term agreement for someone to purchase part of your business, it's a mismatch. So if you are trying to do Google ad spend and you're selling a portion of your company forever for something that actually is a short-term working capital need, you are giving away a portion of your future, not only your future revenues, but also you as an owner of this business, you're giving away that for being able to buy $10,000 of Google AdWords. So really doing an inventory of what is it that you need and what type of financing do you need, and to Julie's point, not raising more than you need. What happened during particularly the last 5 years was the more you raise, the more successful you were. And that's a terrible metric for success. And so really understanding how much you need, raising for what you need. So if you need working capital, looking at things like, for instance, trade finance. So going out and supply chain financing, looking at receivables financing. Can you actually use the receivables, essentially the orders from your businesses or your customers? Have your customers pre-financing you? These are things that, are particularly when you have revenue, are really useful. On the kind of growth capital, but short to medium term growth capital, revenue-based financing is a great alternative. It's non-dilutive. You are able to use historical revenue to qualify for it, and then use future revenue to repay. There are multiple revenue-based financing organizations in the States and elsewhere globally. And then a newer tool that I dearly love is something called redeemable equity, which is a structure where you sell equity to an investor, but you have an agreement for you as a founder to repurchase that equity, either over time or at the end of an investment, or both. And this allows you to have an exit. So it's part of a set of structures that I call structured exits. which is a way to think about the exit as part of the entry, as opposed to leaving it up to kind of whatever
Just
happens.
underscore that, Ani. Yes. Think about the exit in mind. And before someone offers you to buy your company, you got to plan way ahead, because you're going to get excited and you're tired, and they offer you some money, and it might not be the best deal for you. So
Great. And now for the practical insights on the side of investors, Ani, you work with family offices, foundations, and funds globally. Can you share one or two innovative financial approaches that are working particularly well for investors who want to back women-led organizations?
Well, actually, I would say the things that I just said, actually. So I think, you know, I've spoken with lots of entrepreneurs over the years, and you know, as I said at the beginning, there's oftentimes women are told, or when they don't get, you know, VC funding, it's because they're uninvestable. But a lot of entrepreneurs that I've spoken with don't want venture capital funding. They don't want to be on the venture capital treadmill and told that they need to sell their business in 5 years, that they have to achieve hyper growth to even be considered to be successful. And so I think that what I work with you know, in the Innovative Finance Initiative, we have about 400 family offices and foundations as part of the 1,300 members that this like 3-month-old organization has. And really the thing that, you know, we talk about it is fit for purpose capital. So what are you trying to do as an investor? Julie talked a lot about wanting, you know, feeling that impact, that wanting to create, you know, positive impact. And so what are the entrepreneurs, the female entrepreneurs that you're wanting to support? What do they need? And how do you design around that? That might be low-cost loans. It might be working capital facilities. It might be guarantees so that they can access bank financing or other fintech financing. Sometimes it might be, you know, equity investments. But I think, you know, historically, a lot of investors have, when they want to deal with early stage businesses, have seen equity as the hammer. So everything's a nail.
Yeah. Yeah.
That's very
Nicely
good
said.
point. So on that side of investments, Julie, could you please help us break it down the entry points? If someone in our audience is thinking, oh, I would like to invest in women-led initiatives, but I have no idea where to begin, what that will be? And adding to that, can you explain the difference between joining an angel syndicate versus becoming an LP, a limited partner in a VC fund, describing the trade-offs and what one path or the other?
yeah, listen, first, you need to start with what are my core values and what do I want to get out of this? And by defining that, everything else ends up sort of falling into place. So, you know, is the women your main priority, regardless of if they're running an oil and gas company? Like in that WCEO index, there are things that you may say, I don't really want to support gas and oil. Well, that could be a deal breaker for you, or you could exceptionalize that and say, you know what? I still want to double down on women CEOs, but really being clear about what your values are. And what do you want out of it? And that actually, especially as it comes to the private market investing, is pretty darn important. So you define your values, and then you think, am I going to put 100% of my resources that I have investable into this? And who am I getting advice from? And am I going to have to tackle them to the ground and argue with them, or tell them it's my money and you do what I ask? Because often what happens, we talk to our financial advisors, and they kind of, they have to understand their incentives. They might, they get rewarded for assets under management. You take money out of their public market index and you put it into private markets and in venture investing or something. And some of them aren't very happy about that because it reduces their win in their corporate life, right? So understand who's advising you and be very clear about what your goals are without their overdue influence, and keep going back to it and saying, these are my priorities and you need to focus on this. And then kind of looking at, what is my, of course, long-term view, and when am I going to retire, right? But what percentage am I willing to put into short and long-term vehicles? if you're already putting money into retirement funds, a long-term vehicle should be a very simple choice for you because it's already a venture firm is a 10-year life, as opposed to the WCEO ETF or the NIA GX mutual fund, like that's a ESG fund. Like there's all kinds of options out there that are shorter term and liquid. That's one choice. And then there's the long term. So you got to kind of think about what is my overarching plan now. What we did research on the investing behavior of women, and there's biases and things out there that are very untrue. We think women are risk averse as investors. It is not true. What is true is women are more disciplined and risk aware. And I'll give you the example, and they're better investors. They actually make more money over time. And this is the example in the public markets. Women are more likely to invest in a mutual fund. Somebody who's an expert curates a rule or a group of investments, and you're trusting them to pick the right ones. Sometimes you say, and it needs to have a gender lens or whatever, right? And women are more likely to do that. Men are more likely to actually invest in individual stocks. They have high fees for when we're selling and trading those stocks, and they can't get ahead of the electronic markets. So we think men are they're more aggressive investors and using their gut. They're more emotional investors is what the data says. So, which is the opposite of what we think. There's cognitive dissonance there, my friends. So you got to get to the data, and even if you're biased and the culture says one thing, make sure you really understand what's really happening. So if you use that as a concept, we're more likely to invest in trust somebody else to curate it, do a diverse portfolio instead of saying I'm putting all my money in Apple stock, right? I'm going to put it in a mutual fund with multiple things, right, that are included in that. Then if you think about private investing, which is where generally high risk, John, for sure, what you said earlier, but also the way people with the most wealth in this country concentrate their investments and make the most money is in the private markets. So if you think about private market investing, how many of you, asking the audience, have had a friend who says, I'm starting a company, would you put $10,000 in? Well, that is emotional and supportive and wonderful. And that is not a disciplined diligence portfolio process that actually aligns with how women really invest. And so what I can tell you is angel investing is I invest directly in a company because I believe in the founder and the mission or the idea or the innovation, right? Some people make a lot of money that way, but not very many. Most people lose their
Most don't.
Yeah.
Most don't.
It's a very hard way to make money because it's not diversified. You aren't seeing, even if you're part of an angel group, you're not. So I, as a venture capitalist, see 100 investment opportunities and diligence the hell out of it till I get to 1 or 2 investments. I have a professional team. I have a structure and a system. The idea that you as an individual are going to be able to evaluate enough companies to create a diverse portfolio of angel investments is really skinny. Like that is very rare. And I have a friend who's the dean of the business school at San Francisco State. She's made a ton of angel investments, and she's like most of them. And you get diluted over time. You don't have the structures and the financing to both negotiate terms and follow on over time. It's hard to do individual angel investing well. But some of us get a lot of reward for doing it. So back to what do you want to get out of it? If I want to be able to advise a company, if I want to help a founder, if I want to be in the know, if I want to maybe go on that person's board, you could have reasons outside of financial returns that actually make you want to do some angel investing. But as a financial tool, it's most likely better that you invest in a venture firm that is aligned with your values. And some venture firms, like mine, actually are designed to help first-time investors get experience and visibility and access. So I have a venture firm fund team. They evaluate the deals and make the investment decisions and do rigorous diligence, period. But we invite our investors to every month they get to see a investment screening pitch call where 4 companies pitch, and they get to ask them questions in the chat, and we curate it, but they get to see the questions other smart people ask. They get to see the innovation in the market. And so
Mm.
if you need to say, what do I want out of this? And will this venture firm deliver that? Do I just get a quarterly or annual report, or do I actually get to meet the founders? Like I just did a retreat last weekend with all of our LPs, not all of our, a bunch of our LPs and founders. People get to spend a day and a half with our founders. Like how yummy is that? So they're part of a venture investment group, but they get that one-on-one experience. And so again, like, what do you want out of it? Do you want this to help propel your career? And when you go to a networking event and you say, I invest in venture and biotech, that changes how people talk to you and think about you as a board candidate or a leader in the next company. It can change your life to actually be involved in this power play. And women have never been invited because we didn't have venture funds designed for us and by us. And so
Right.
there's a new day. I want to encourage everyone to lean in and think, how can I get my professional goals met, my values aligned, impact goals met?
Love it. Yeah, this is a constant invitation to our audience to think about these questions. Um, Yes, the financial tool, the financial return, this is a vehicle of wealth creation, which is also very important. And that going alongside value systems, beliefs, impact driven passions, outcomes that you want also to incorporate as part of your life and financial decision making. Those are excellent models for daring investment in women. And so just to recap, we have learned from Julie about VC investment and funding options. On the other hand, Ani shared about alternatives funding beyond VC. And John, you have written about the power of customer-funded business models and the importance of confidently asking for cash as a key entrepreneurial mindset. Tell us what is this about and how can women founders effectively apply this approach? And just before we going there, a kind reminder to our audience, there is a Q&A feature here in the webinar Zoom. So please feel free to start, putting there your questions. Our team will read them and passing to us. For at the end of the session, we will read them and share them with our panelists. John, please go ahead.
So thank you, Jimena. So several years ago, I wrote a book called The Customer Funded Business, as you know, and that book came about because earlier I'd written a book with Randy Commissar, a venture capitalist in California, about business models. And in that book, we wrote about Costco, and we discovered something very interesting about Costco. We all pay $60 or whatever to join Costco. Well, did you know that 2/3 of Costco's operating profit each and every year is your $60 and my $60 all added up? If your target, imagine having to compete with that. So Costco has a rule that nothing can have greater than a 14% gross margin. Well, at Target, things have 20, 30, 40, sometimes 50% gross margins. You can't compete. Why? Because we gave Costco this money up front. So that led to the book, The Customer Funded Business, which talks about the 5 ways that a founder, and again, my focus is on founders here. Julie's been talking about investors, but my focus is on founders. And I want founders to get their money from their customer. And you might say, well, why on earth would a customer give me money up front? Well, ask yourself why you pay Costco, for the privilege of shopping in their store. Ask yourself, why does Michael Dell ask us to pay for the computer before he builds the computer? Ask yourself the story of Tesla. So when Tesla got started, when Elon Musk joined the Tesla team, which already had a vision and a plan, Musk said, well, let's go sell some cars. They hadn't built any. They did a roadshow in California and they sold 100 Tesla Roadsters for $100,000 a piece, cash paid on the barrelhead tonight. And that was the capital let them, do the tooling and begin to build the first Tesla Roadsters. 10 million bucks in the bank from customers before they built the first car. Well, when they rolled out the Model 3, it was the same thing, except it was 500,000 customers putting down a $1,000 deposit. Do that math, right? $500 million up front paid by the customer with which you can do whatever you need to do take the business forward. So those things are part of what led to my new book, Break the Rules. And it's about the mindsets of entrepreneurs. And I think what founders can do, if they choose to, if they don't want to play the investment game, is say, how can I start a business that is so compelling to my customer that they will pay me up front before I deliver the goods. Now that might be a subscription model kind of business, right? It might be like Costco or Tesla or Dell, where we just pay for what is delivered before we get it. Most service businesses, you pay something up front, right? When you buy a service, you pay, at least in part, in advance, because that's what service providers want. They don't want to give the service and then have you walk away and not pay. So if you have a mindset that says, well, I'm going to get the money up front from my customer, and it doesn't have to be just at startup. It can also be at growth stage. So I was in Puerto Rico 2 weeks ago, working with a bunch of entrepreneurs who are with businesses of what, 5 to 10 million revenue and sales, and they're all trying to figure out how to grow. Well, if you don't have to get every one of your customers to now pay you up front, but if you can look at your customer list and say, which of these customers might have a reason why they'd be willing to pay me up front, ideally a pretty big customer, so that the money would be significant. Then you ask them to do that, and maybe you give them a slight discount or you give them some other reason to do that, but that's how you fund your business. So in my mind, the real solution to this gender lens investing challenge we face, if I'm a founder, is let me figure out a business that solves a problem that is so compelling that the customer is going to pay me for that, at least in part, up front. So that's why I said before, there's some things we do before we even start the business that enable us to solve the investment problem by getting it from our customers. Now, once you've done that, and you go along and make some progress, at some point you might find you really have something that's very exciting and needs more capital to grow, and then maybe you go to a Julie and say, look at what I've created so far. Look how capital efficient this business is. Julie, you used the word capital efficiency before. Would you fund me to help me grow this thing? So that's where I think founders should go.
That's super interesting. And I love the diversity of perspectives of how we're tackling the same challenge. And just briefly, one reaction from Julie and one reaction from Aunnie to what John just shared.
Not only are you 100% right, it's culturally interesting right now, but I'm going to double down and read that book again, because I read the first one at one point in time, but it's time to double down. This is the thing. I want to give you an example. Baby Quip is a baby equipment rental company. When you travel, they have a partnership with VRBO, and they have 3,000 quality providers, stay-at-home moms, primarily women of color, making $1,600 a month on average of supplemental income. Kind of a big deal. And they have, of course, thousands of clients around the world who have babies and their back hurt when they were carrying everything. So someone delivers your baby stroller wherever you're going to arrive. She's basically raised almost all of her money through crowdfunding. She's doing a $4.5 million crowdfunding raise, right? And might not even have to do a Series A. And it's all her customers and her clients and, and her, I'm sorry, like quality providers. Like that's how, that's a workaround, John, that is both necessary for women and also can be really great for the business. Because if you haven't read the book Founder's Dilemma, don't take venture funding if you're not sure you understand the game and you want the money, because you may be fired from your own company and never make any money, and you are the one who put in the blood, sweat, and tears.
Yeah, I just think it's brilliant, John. I think that's, there's working capital and growth capital are both and you can solve both of them with your customers. So, I mean, the growth capital is much more of a hack, as you're talking about, like really, but the working capital piece, I mean, we pay for, so many subscriptions up front, right? That is because we're funding tech companies' working capital. So you get a 30% discount because if you pay, and so I think it's just bringing the mindset for founders into it's actually, it's about like it's not about having an idea and going out and seeing how much money you can raise. It's about building a business that is capital efficient, that sells something people want to buy, that that is right. The question I always ask my students, always, and they always get it wrong, is like, what is the cheapest form of financing? And they'd be like, grants, your parents, whatever. It's revenues. Revenues are how you should be financing. And so it's about, internal financing of like, how does this business work? And like using your customers is just a perfect way to talk about that. And then, but we're just so focused on external, look, I raised $3 million from a venture capital fund. And so I'm very surprised by this conversation. Like I'm super, like I love it. Like this is not what I expected, but it is just, I think really rethinking, how do women grow and run really successful businesses is not just about changing the number of people that are sitting around a table making decisions at VCs. That's great. Let's do that. But also, let's really think about building really good businesses and, funding those, from revenues and from customers is just a really good way to do that.
And
Yeah.
if you ask a customer for money with your new idea, and the customers don't want to give you any, that's pretty good feedback to have, isn't it?
100% in the impact space, John. One of the things that you talk about, right, is that when you are working with the base of the pyramid, Julie said this earlier, when you don't have a lot of cash, you make a lot of decisions. You make decisions a lot more, with a lot more like essentially thought, right? So if you're making, $200 a month, you're going to think really carefully about buying something that's $25, $30, $50. And so, for a lot of impact businesses, they can design the coolest thing that they've ever, seen, the doohickey that is like, looks beautiful. It is not valuable for the end user, valuable enough for them to part from their very hard-earned cash for that. And the only way to prove that is to actually sell them. And I think that's where you can raise a ton of money to go out and try and flog something. But if people aren't going to, if you're asking your customers and they're not paying, you think it's valuable and it's not valuable enough for them, then, that is a really
Data.
big.
They won't buy it early.
Yeah.
Some,
Yeah, the raising capital piece being very important at the same time, and the essence of the business is the mission and the revenue model, like what you're building, why you're building, for who you're building it, and make sure that first revenue engine is working well.
I just one last.
Yeah.
Oh, go ahead. No, I was gonna say I thought.
It's interesting because I just had this retreat with all these founders, and this is the thing. Yeah, women are more capital efficient, performance driven because they have to be in discipline. I'll tell you, I've been running stuff for a long time. When you don't have when you are worried about payroll and cash is really tight, you also aren't always making the best decisions. It is not to be glorifying people
Agreed.
dying on the vine and starving to death. We have, and sure, it separates the wheat from the chaff, they call it. So we have a portfolio company founder, a geneticist from Harvard, and she had to do. She won 36 pitch competitions to fund her company in the year one. Won 36 pitch competitions. That's the only way she'd get it funded because no one would listen to her. That, okay, fine, that's grit. She had to revise, and get better and better, but that's not where we want her spending her time, this geneticist, right? And so I don't want to glorify this, the fact that this is the result of the environment. I don't think too much money is great because then you go hire the wrong people and you overspend and all kinds of stuff, and then you fire half the team. And I've seen that a million times as an investor. But it also is the opposite, isn't so great either. There's somewhere in the middle that all of us need to be.
Agreed.
Aunnie, you wanted to share something?
No, I agree. I agree with that. That's fine. I agree. We can keep going.
Got it. So we're moving to the last segment of our conversation today. And I want to shift to something equally important to what we have been sharing so far, and is male allyship. We're championing more women investors, backing more women founders, and we also need to consider the broader ecosystem. John, what role do male allies play in advancing gender lens investing, and what strategies work best for engaging them as active participants?
Jimena, if I'm perfectly honest, I'd say to a woman founder, forget about male allies.
Okay, I love it.
That's not what you need. You need to create a compelling business that solves a compelling problem for your customers. And if you can do that, you'll find a way to get it started and you'll find a way to grow it. I wouldn't even worry about it.
Yeah, that's very interesting. Ani, what's your perspective?
So I mean, I think what we need is we need people that are able to look outside of their own lived experience, because you don't have to look very far to hear examples of both female founders, but also impact founders, founders that are doing things for people with disabilities, with just things that are we are generally really good at thinking about our own lived experience, and so if you're the founder of Spanx and to a guy, you might be inventing ugly underwear. To a woman, you're inventing something that's, groundbreaking. If you are a good friend of mine from business school, founded essentially it was Airbnb for people with disabilities, and he sold it to Airbnb. But it was, he was solving a problem for him of how he booked things when he was traveling, in a wheelchair. And when he was pitching it to investors, like they didn't understand the market because it's not something that they'd ever done. So I think allies are amazing, but I think the thing I would say to everyone is, because we can also have a bunch of wealthy, white, upper middle class women making decisions that are not necessarily going to reflect other people's lived experience. And so I think it's just stepping outside of our own lived experience and understanding when someone is building a business for something that is valuable, is useful, all the things John said, and all the things that I'm sure Julie has on her due diligence list. But really being willing to interrogate something that is not in our own lived experience.
Love that. Julie.
It's interesting. There's all this data. I do the women on boards work often, and when you disrupt groupthink, you win. Groupthink is the killer of everything. If you have all one type of person that has one perspective, it's actually very dangerous. We actually can see very clearly with corporate board diversity. You have one woman on a board or one diverse person, their voice isn't heard. If you get 30% or 3 out of 10 generally, that's actually protective. Companies perform better. They actually, product recalls happen 3 times faster. Why? Not because those people have better perspective and are better. It actually upgames everybody. It disrupts this lazy group dynamic thing where you protect the group even though things go against what you believe. So look into groupthink. It's actually fascinating, and question yourself, because I can be with a whole bunch of 50-year-old women like me and we are not seeing the whole perspective. Let's be clear. And so it upgames. Everybody prepares differently and better for a meeting or whatever you're doing, because you have to bring your real perspective, and you're not just like, well, John always knows how to do the finance, I'm just going to rely. I don't have time to really look at the financial numbers the night before the meeting, but John always takes care of it, so I'm gonna like rest on my laurels. That's not good. It's better if everybody actually shows up fully, and it happens in diverse groups. So I think, Ani, I think you just named it to me. And if we all are just cognizant of that, the danger with women in this space, though, with allies, is, there's a lot of parts of this, but women are told you have to have a male co-founder, you can't raise money. It's been true.
Wrong.
And it's not good, because as
Yeah.
an investor, what I watch happening is a couple years down the road, the guy who was like the friend who just lent his voice, all of a sudden the human behavior, it's not men. Money shows up, success shows up, and all of a sudden he's like, well, I had a bigger part in this and I want more. And that gets lawsuits happen. The other thing that happens is the other investors see men for their potential, and this is cultural. Men are hired, promoted, and invested in for their potential. Harvard studies show this. Women are hired, promoted, invested in for what they've done.
Yep.
So the woman starts this, kills herself 4 years down the road. The company's ready for a growth cycle, and the other investors go, Jeff really is the growth guy, and we're just going to have you now become the head of whatever, and we're going to have him be the CEO. It wasn't his idea. He didn't build it. He doesn't know the nuances. So dangerous things happen when we kind of are forced into a box just because of gender in that case, but it can happen in other ways. But we're talking about women right now.
Yeah, and that takes me to the last question. What's the most important systemic change needed to accelerate gender lens investing, and how can the leaders in our audience contribute to that change? 1 minute answer each. Let's begin with John.
I'm not sure that there's a systemic answer other than creating another couple of thousand Julies. You know, we need more and more capital to flow. We need more and more people organizing organizations like Aunnie's. That's what has to that's what has to happen. We're not going to change the fundamental system, but we can do an end run around the system, and I think you guys are two of the people doing that.
Love that. Aunnie?
It's tough. I've been, I mean, I would say I've been thinking about a lot about this lately, but I mean, it's kind of my job and what I do. So yeah, I've been thinking a lot about it for, the past 15 years. But it's, for me, it's not just women. There's the economy, the financial structure does not work for most people. And so just so happens that a lot of those are women. Most of them, are outside often of urban areas, are not white, a lot of them, people of color. So I think there is a fundamental shift that needs to happen with economic systems, and with financial systems, and thinking more about, more distributed ownership of assets, of power, of governance. And, I think that's just, it's a stark difference to the reality that we're in, where the wealth is becoming more concentrated as opposed to more distributed. And I think that female ownership of that wealth and control will change that, because we do know that women make different decisions, with capital and with assets than men do. So how we shift this is that every single one of us makes decisions every day in around how we're using our capital, how we're using our resources, how we're using our voices to empower those people that do not have agency, to lift others up and around us, to tell stories of people that are, doing work that needs to be heard, and to fight back against the narrative that this is because this is how it's always been, it's how it always will be, because there have been massive financial shifts in the past, and there will be massive financial shifts in the future. And so, we need to be working towards what does that look like. And I do think there's no easy answers, but I do think more women being in power and more women owning and controlling assets, is part of the answer.
I love this. We're almost at the end of the time. We will ask our panelists if kindly we can stay 5 minutes so we can cover a couple of questions from our audience, and also our audience, if you would like to stay this 5 minutes to get into those questions from the Q&A. Before that, Julie, please share with
I
us.
just have 2 minutes. I'm a pumpkin in 2 minutes. I can't stay for 5.
Oh, any idea about systemic change needed?
Oh my God. Well, that's what my life is. So this is the thing, like as I said, a lot of this is new. We've never before had a generation of women that we have today that have such extraordinary operational expertise, that have the power, wealth, and influence that we have. Women have 52 or 53% of the wealth today. There's a massive wealth transfer happening. We actually see things wholly different today than 10 years ago. I don't know if you know this, but 45% of households that are heterosexual in the United States have a female primary breadwinner. I'm that person in my household. I've been with my husband for 36 years. He's the sweetest man on the planet. He's an acts of service man. He props me up. And if I said you were in charge of our financial future and you're on and I'm off, in our family structure, in who he is, that doesn't work for us. He wouldn't handle that stress. I can handle that stress. And he was, he stayed at home for 6 years with our kids, not the whole time, but we have to have a healthy relationship balance option in all family structures, whether you trade off at times, whether one person has one role and the other person has another. 45% of households with a female primary breadwinner, I'm talking about heterosexual households, not single mothers. I'm talking about people who are partnered. that means it hurts men if we don't fix these, and families, if we don't fix these economic structures. It's
Mm.
terrible for everybody if we can't adjust and evolve in a better way. So all
Mm.
better off if it's just, whatever's right for the person. We all have different personalities and
Yeah.
temperaments and
Yeah, that's part also of the systemic change, like at the macro level, such as the structures and systems of finances in economics, and also the agents of change that John was mentioning, and at the same time at the household level, where the decisions that were taken at that level, the relationships that we're building, the role balancing, and so on. So thank you for those rich insights and practical strategies, and we're opening up to the Q&A chat from our audience. So one question is, how do our panelists feel about private equity being included in target funds and retirement accounts?
Mhm. John, do you have your thoughts on this?
That was really a question for Julie.
Oh yeah, and she just dropped off. Oh my God.
Yeah.
No, I mean, yeah, I've got thoughts, but John.
Um, it's fine. I wouldn't choose to have a lot of that in my retirement accounts, but some do. You're paying an awful lot for that private equity money, and the performance of private equity funds is widely dispersed. Some of them do very, very well. Some of them don't deliver much at all. I don't have strong feelings. Maybe, Annie, you do?
I think it's a scam. If you want to listen to some really good thoughts on it, The Economist had a podcast on it about 3 weeks ago. And it really looks at, the fact that this is the next growth market for the private equity funds themselves, not necessarily good for the underlying. And I think there's the data is clear that it's a useful thing for large asset owners to own. I do not think individuals putting money into private equity is going to end up being better for the individuals. I think it will be great for the growth of the private equity market and wonderful for the private equity managers from a fee perspective. I am highly doubtful that it will result in better asset accumulation or better outcomes for individuals. So I'm very concerned. And I also think the private equity buyout model as it currently exists is negative overall from just a societal perspective.
Nicely said.
And then last quick question, what marketing strategies or storytelling approaches have you seen work best for a business aiming for the customer funded model?
Great
How do they build
question.
trust or excitement early enough?
Well, I think it comes down to understanding a customer need well enough that you can convince a customer that your solution is going to solve a problem that they have. That isn't a particular strategy or a particular storytelling approach. It's a function of deep understanding of what a particular group of customers needs and wants. And if you have that deep understanding, sometimes that comes because kind of we are the customer at the beginning of the business, but sometimes you have to understand it from your customers. But once you figure that out and understand a customer well enough and say, I can solve that problem and I have the skills and the networks and whatever I need to do so, uh, there's no particular approach. Just go do it, as the Nike slogan says. Just do it.
Any insight in this, Ani, for this question?
I just find, I mean, my customers, when I'm designing things, I'm designing normally financial structures, and I just find that I need to do co-design. So co-creation and co-design. So designing with, family offices around the table to create something is way easier than building something and then taking it out to people and being like, look what I built, like look what we did. And so I think that probably applies to businesses when they're doing this too. People want to feel heard, they want to feel involved. That's why crowdfunding, is so useful. So, making people feel part of something feels better than just being a consumer. And I do think that's it's not just storytelling, it's real doing, as John was saying. Like it's not just, crafting a narrative. It's actually really, engaging and being authentic, and having people understand that what they're part of.
Amen. Amen.
Love that. Well, thank you to our incredible panelists. We have reached the final part of our webinar. And thanks to all of you for being part of this important conversation. Together, we can close the gender investing gap, one decision, one investment, one partnership at a time. And let's turn this insight into action. Thank you, everyone, and have a nice day.
Thanks
Thank
so
you,
much.
Jimena. Nicely done. Nice meeting you, Annie.
Thank you very
Nice to
much,
meet you
John,
again.
Aunnie. Thank you. Bye-bye.